Cashflow Diary Podcast, episode 433.
Welcome to yet another exciting episode of the Cashflow Diary Podcast, the podcast that teaches you insider tips, tactics, and strategies for creating leverage streams of cash flow into your life. Learn from top-performing entrepreneurs, business owners, investors, and thought leaders from across the globe as they share their secrets to success. Like what you learn on this and other Cashflow Diary podcast episodes? Go to learninvestingnow.com and sign up to receive powerful tips and information that will help you succeed as an entrepreneur and investor. Now, here's your host, investor, entrepreneur, business owner, educator, speaker, author, and master facilitator of Robert Kiyosaki's cash flow game, Jay Massey.
All right, ladies and gentlemen, welcome to another episode of the Cashflow Diary Podcast. I'm your host, Jay Massey, and I'm glad that you are here today because we're going to talk about something that I know you are thinking about. More importantly, not only are you thinking about it, you're wondering what to do about it. And I think today's guest is going to finally be able to give you some actionable understanding so you and I can make better decisions. When? Right now. I have with me today none other than Harry Dent. He's the founder of Dent Research, and I think you are going to enjoy a lot of the things that he has to say. Now, before we get into that, understand he's one of those individuals that we all appreciate because his experience, well, it's not from a book. It's from hands-on. Harvard MBA, Fortune 100 companies he's worked with, down to getting them started as well. Here's the point. He's been on Good Morning America, PBS, and all CNBC, CNN, CFN, and a lot of places. My point to you today is that this is going to be one of those episodes that answers a lot of the questions that I think you have in the back of your head. So make sure that you're ready to take notes. Make sure that you're ready to listen. And, you know, this one would be okay to listen to more than once. So let's get ready to understand what 2017 and beyond can look like for you and I as we talk to Mr. Harry Dent. Harry, there?
Yes.
Excellent. I'm glad that you are here, sir. How are you so far?
Good.
Excellent. So this being the first time that you are here, I have to ask you the same question that I tend to ask everybody the first time that they're here. Are you ready?
Yes.
All right. So I tend to look at today's entrepreneurs a lot like yesterday's superheroes, you know, Batman, Robin, Wonder Woman, Superman, etc. And I think entrepreneurs and superheroes have a ton of things in common. Chief among them is that, well, occasionally entrepreneurs, we get dressed up and maybe we, in our own minds, we think we're wearing a cape and tights and all this other stuff, but we are using our special skills and abilities to assist customers with their problems and improve their quality of life. Now, also, like superheroes, entrepreneurs have a beginning. So my question to you, because if you think about, you know, Spider-Man, before he was Spider-Man, he was just going around and, well, you know, going to school and taking photos. That's kind of what he was doing. So then something happened to him and then he changed. So the question is, before, you know, the success that you've seen, before the Fortune 100 companies, before your new book, The Sale of a Lifetime, before all of these great things that have happened for you, what we want to know is, who is Harry Dent?
Well, you know, I tell you, I had no idea what I wanted to do through high school. I finally got that I wanted to be in business somehow, inspired by my father-in-law. And so I started taking business. And I worked for Fortune 100 companies directly, you know, in-house and in high finance after college. And I just said, oh, this is boring. Went to Harvard Business School, and I really found out what my talent was. And, you know, I could really see the big picture. I could think on my feet, and I could argue very, very well. I didn't even know I had those talents until I got into a very interactive format there. I came out and worked with Bain Company, consulting high levels to Fortune 100 companies. That was a lot more fun, but it's still, those companies were too slow for me. So I basically started working with entrepreneurial companies in California after that in the early 80s. And that's when I discovered demographics. I already understood a lot about business cycles and life cycles. And then, you know, Harvard Business School and Bain are just great on that. I learned about demographics because these entrepreneurial companies were appealing to the young baby boomers who were starting all the new trends. And young people are the ones that start trends in my demographic work. And so the more I got into baby boomers, the more I learned about demographics. And now I know everything about demographics. I'm probably the world's leading expert on how demographic trends, the aging of our society, affects our economies, and the effects are massive. So I did my kind of Malcolm Gladwell 10,000 hours immersion. He talks for outliers. I mean, I became an entrepreneur myself because I reinvented economics in the 80s. And then I got some really powerful indicators together, which I'll talk about today, in many sense. And that's when I published my first book in 1989, predicted the collapse of Japan in the 90s, while the U.S. and Europe and the rest of the world would have the greatest decade in history, all because of the baby boomers, and they would be in their most rapid spending and productivity years. And ever since, I've been publishing books and speaking and writing newsletters and stuff. So, I became an entrepreneur myself. I would have not seen myself as an entrepreneur before the early to mid 1980s.
Well, and that's kind of what I like about what you just said is, I mean, you started off like, look, I had no idea what I wanted to do through high school. And there's so many of us who probably felt that way. And it sounds like it took a few years, even post high school, because you said the words, I discovered my talent. And then you were able to enumerate them very, very well. And I think that's amazing because a lot of people are still trying to figure out how, what it is that they're going to be good at. I think every entrepreneur has what I call their superhero ability. And then they have to make the decision. Am I going to use this for good or for evil? So could you, for those that might still be trying to find that for them, what was it that clued you in to go, oh, this is what I meant to do?
Well, again, I got thrown into Harvard Business School, very hard to get in. I got in. I figured I was going to be the dumbest person in the class. And when the first few weeks, I realized I was the smartest person in my class. And you're in a group of 80 people. There was 10 sections of 80 people. And all you do is argue over real life cases. There's no theory. The professor's not sitting there lecturing to you. All he does is conduct a conversation. And I was like really good in that format. And so I realized, man, yeah, I can think. And my father was a political strategist. I realized I'm a great business strategist. I can see the big picture. I can see the forest for the trees, and I can communicate it. And I think outside of the box. I mean, the professor's job there was to conduct a conversation that kept lively and would bring out all the key points. He would always come to me when he wanted the left field view. When he wanted somebody to think out of the box, he knew to call on me. So I just realized I'm an out of the box thinker. I'm a strategist, and I'm really good at communicating. I would have never seen myself as an author, nevertheless an entrepreneur. Business strategist I could have surmised before then, but author, writer, speaker, no way.
Okay, so let's talk about that, because you had some experience previously in what we would traditionally call corporate America, high-level corporate America at that, which, if I remember you correctly, you said you found it was boring and or slow, which I thought was
it was both. Working in a company was really slow. I would go to work, and I soon learned people were slow there. And so I would do all my work in the first 3 hours in the morning when I'm at my best, and then I would just go up in the library and read books and magazines and stuff, because if I sat around and did twice as much work as other people, they would all look stupid and slow. So I had to hide, and it was boring. And then Bain Company, we did very interesting work and traveled and worked at the highest levels of corporations. That was great. But then I remember my first project, it took me 6 weeks to develop a model. That's also when I realized I was a good forecaster, because I had no background in that, for tires at Firestone, and came up with a simple model that beat their $1 million model. Had a staff of 11 people feeding this monster. I came up with a model on a napkin with 3 variables, like I have for the economy, that predicted the downturn in tires that happened because of rising oil prices, lower driving rates, and changes, and radial tires lasting twice as long. So, it's just one thing led to the next, and next thing you know, I'm not just a down the road I become an entrepreneur, then a speaker and writer, and then a forecaster. And it's happened in that order. And again, none of those would have somebody else predicted for me. I wouldn't have seen that. I mean, some people, Bill Gates and Michael Dell, they knew what they wanted to do when they're 14 or something. Some kids know they want to be an actor or something at 4, literally. To me, it just kind of happened, one accident after the next, till I ended up being what I am. And and literally it worked out for the best. Even compared to, I could have been a good business consultant continuing at Bain, but what I do today, I reach many more people, and it's much, much more fun. And of course, I naturally attract a lot of entrepreneurial people because I think like an entrepreneur. Yeah, and I'd rather deal with them. They're more fun.
Well, we totally appreciate that, and that's exactly what I hear in your voice, your energy, and more importantly than that, what I want everyone else to hopefully pick up on is you were open to going where, quote unquote, as they say, life may take you. You didn't really know, but you didn't say no either to the opportunities as they presented themselves. You were open to discovering, hey, I might be good at something, as opposed to saying what sometimes we can go, well, that's not me, or I don't think that's me. You just said, okay, you need a model, forecasting, let's go for it. And you came up with something. Did you even know that there was an 11-person team on the other end, or did you just come up with that and find out?
Oh yeah. We knew, but we knew from our insights that trends were changing, and of course they just keep going in the same direction. But I tell you that the biggest thing I did, Jay, was I jumped off a cliff when I left Bain Company. I mean, that's like working at Goldman Sachs or something. It's just an incredible job with incredible opportunity and high pay and benefits and all this great stuff. When I moved to California, started working with entrepreneurial companies, I couldn't charge anywhere near as much, and I had to build a business from scratch. And I jumped off a cliff there, but my intuition, was very, very clear that that's what I needed to do. And I got an offer from an entrepreneurial company at first to go out there, and then so I just took it, and then I started consulting. And so it just happened. But yeah, I mean, entrepreneurs also have to take calculated risk and based on vision and or just really good calculations. That something it may look risky, but you think you can pull it off for this or that reason. And so, I mean, that's part of it too, not just vision and not just being willing to change, but you have to take calculated risk.
Indeed. And that's exactly what I was That's exactly what I'm hearing, and what's important is that you segued right into where I wanted to go, was because every would-be entrepreneur reaches that point where they go, all right, am I going to cut the strings of what I'm familiar with and go for this unknown? And they face this point of, all right, I see that I've got this skill. Am I actually going to go out there and use it? Do I believe in it enough? And I guess the question to you becomes, where did you develop the courage and confidence to do it? Because many listening are at that stage right now going, man, I want to do it, but all of these other things.
Well, that just comes naturally. I mean, when it came time, I just did it. I wouldn't have thought I had that courage either, but you also have to do it. If you're going to jump off a cliff or take a big risk, you have to do it intelligently. At least I had a company I could start. I could be the CEO of to start out. I mean, I started out with a job. It just wasn't as lucrative and as much potential as Bain Company. And then from there, I started seeing opportunities I took over some companies in turnarounds and stuff and all that sort of stuff. So I built from there. But if I'd have just, given up my job at Bain Company and just moved out there and hoped to find a job, that would have probably been stupid. And that I might have, been in a lot of difficulty. So,
Sure.
If you're going to transition out of a normal job to starting your own business, hey, do it step by step if you can. Start your business at first on the side. And the key thing for any entrepreneur, yes, you got to have vision, you got to have a strategy, all this sort of stuff, but it's never going to work out the way you think. Mine never did either. You got to constantly test things, test and test and test Don't just gamble $1 million, raise $1 million, and gamble on a marketing campaign that you think will work, because it may not. Do the first 50,000 and test, and then learn from that, and then invest another 100,000. So do it step by step, test. If you're going to do something radical, do it intelligently. I see most entrepreneurs fail because they so believe in their vision that they just jump off a cliff with no net.
Yeah, totally understand. And I got that. Now, you live in an area, meaning in terms of your work, that I totally love. Because I'm always telling people, especially as a long-term real estate person, one of the things we've got to be cognizant of are trends, and macro as well as micro economic trends, because where the jobs go, so does the business for a lot of us that want to develop cash flow in any sustainable manner. And this is like your entire world, is understanding slices of populations and demographics, because it's like the centerpiece of everything that we're talking about all the time. Is the property the right design for this type of person, or the type of person you think is want to live there? What I want to understand is, what is it about demographics to you that gets you so excited? You probably are the most excited person I've ever heard, outside of myself, gets excited about this type of information. So I'm really curious.
Well, two things. When we didn't have a middle class before Henry Ford, and really not really until just after World War II. Demographics middle class consumers made demographics far more important, because now you're not dealing with peasants and stuff like that have almost nothing, no capital, no substantial income. Second, the baby boom made demographics way important, and it happened around the world because there's so many of them. You don't get generations that large, except, as I found in cycles, about every 250 years. And the last time we had a generation like that, we had the American Revolution and the Industrial Revolution. Free market capitalism met democracy. Harry met Sally, and we've been growing like crazy ever since. It was a big breakthrough. So, and if there's a strong wave of generations coming along, it's going to foster innovation when they're young. It's going to foster spending and productivity in their midlife. And then they're going to retire and do all these predictable things. And the economy may slow, but hey, nursing homes are going to grow. So, we've got demographics down. I started with understanding very quickly that the average family spends the most money in their entire life at age 46 after entering the workforce at 20. Now, people do all types of stuff, but averages, like life insurance actuaries have learned a century or more ago, you can predict a lot of stuff with that. But I've learned everything in between. When do they spend the most money in healthcare? When do they buy potato chips and eat the most calories and shop at grocery stores? When do they buy their first car? When do they buy their best car? When do they buy their first home? When do they buy their trade-up home? When do they travel? And after they get sick of traveling, they go on cruise ships for the next 10 years, which are easier, and they just get stuffed with booze and food and don't have to change rooms and go through customs and fly around and all this sort of stuff. And then it's healthcare and nursing homes and stuff. So anything, what demographics and an understanding of the type of cycles I study can help, an entrepreneur or any business person is, hey, if you're going to take a risk, you're going to have a better chance of succeeding if you're taking a risk in a trend or a cycle that is growing rather than declining. The last thing I would do is try to start a new chain of car dealerships right now, because that's the last major sector of spending, durable goods, to peak for the baby boomers, and autos are now going to, in the coming years, are going to crash just like housing did. Housing peaks first, then furnishings and furniture, and then automobiles. So housing's at 41, furniture 46, and age 54 or so for automobiles. So that's going to a declining demographic. George Soros, Warren Buffett, two of the richest people and investors in the world, invested in major automobile retail chains. Wrong bet. Smart people, but if they just would have understood one simple fact from me, they wouldn't have made those investments. So this gives you another advantage. There's still other challenges you have to have. The biggest challenge I've found in entrepreneurial businesses is getting the first customers. Marketing is the challenge. It's rarely the technology. It's the damn marketing. And that's why most businesses fail, and they overinvest in marketing. They don't test it enough. They think they know it's going to work, and then they run out of money from their first stage investors, and then nobody else will give them money without very high valuations, and then they fail. So, but knowing the cycles, I mean, knowing what millennials are going to do next, the younger generation, knowing what baby boomers are going to do next. And if I had to recommend one sector that you'd have to be an idiot to fail in, it would be nursing homes. That's the strongest single demographic sector I have for the next 26, 27 years.
Okay, well, so you're headed down, because when I was looking at what we were going to be talking about today, there's something I've been telling people at many of the workshops and places that I've been that is very similar to what you're saying right now. That's a real estate play that I believe is going to do well for the same reasons that I think you believe that nursing homes is going to do well. And I think that play has a lot to do with funeral homes, simply because it is real estate. They got to end up somewhere at some point, and you're selling very, very small plots of land for a very, very high margin relative to the price that you could probably buy land for today, but you'd have to make the investment today. And I'm just like, so my question to you is, what do you think about, trends when it comes to, as they relate to any additional real estate plays that might exist? I mean, am I crazy with this whole funeral home idea, or what? Hello there, entrepreneur. This is Jay Massey, and what I want to say to you is that the number one mistake that I have ever made in business, number one, has been waiting too long to do the books, waiting too long to get the bookkeepers, the accountants, the CPAs, the CFOs involved, and I don't want you to make that same mistake. That mistake cost me over six figures, and now for a significant discount, you have the ability to get your books together using FreshBooks. So what I want you to do is I want you to go over to gofreshbooks.com/cashflow diary. Again, that's gofreshbooks.com/cashflow diary. FreshBooks is the easy to use software designed to help you, the small business owner, the freelancer, get organized and save time on invoicing, getting paid faster, keeping those books in order so that it becomes a bonus for you to do your taxes as opposed to a burden. Go over to gofreshbooks.com/cashflow diary and get started today. And now let's get back to the rest of the story.
No, it's just like nursing homes. The only difference is funeral homes peak about age 80 because the average rate of dying, and nursing homes peak at 84 because women live longer. And if you've ever been in a nursing home, there's 9 women for every 1 man, and men have more sex than they've ever had in their whole life. So that's it. No, same demographic. There aren't many things, though. The baby boomers are done buying houses for their kids because they don't have any kids anymore. They've all left the nest. The only thing left is a second round of vacation and retirement home buying into age 65. And then things like funeral homes and nursing homes. Hospitals will grow for a number of years, but they don't peak as late as a lot of people think, because most people start having major health problems in their around 60, early 60s. And that's when spending on hospitals peak. So, but the point is, I can put a number on almost anything, including potato chips at age 42. So people should understand that. And on our at our main website, dentresearch.com, we've got a book called Spending Waves, and we outline the most important of those. I could sell that research to a Fortune 100 company for $20,000 in a heartbeat, because that's about what it took us to develop it, to get down to that level of detail. But this is powerful stuff. We show the economy peaks on a 46-year lag to the birth index, and I can project that anywhere around the world. And hey, baby boomers already peaked. We peaked in late 2007, just as I said 20-some years earlier would happen, and we've been living off of quantitative easing ever since, just to barely grow at 2%, and we're not going to be able to do that once we've already hired back all the people that lost their jobs in the Great Recession, and we're back near full employment, so that's not going to last much longer. So demographic trends are down for the economy. And the only thing keeping us alive is quantitative easing, and that's working less and less and less, as we also predicted, although it did last longer than I would have thought. And so you've got to find, even we see a big financial crisis coming. Well, that's really bad for most large companies, but entrepreneurs do well in downturns like the 1970s and 30s, because all types of new markets open up from new innovations from the next young generation, but also you get a lot of businesses exit businesses that they're not doing well in, and now there's places that entrepreneurs can come in and do things differently and grow. So I see a lot of opportunities ahead, but you gotta understand the next 3 and even 6 years, when I go out a little more, 3 years in particular, 6 years in general, are going to be the worst economy any of us have seen in our lifetime by my forecast. I got not just demographics, but 4 important indicators that I've found over 30 years are the 4 that make the most difference for the economy. I mean, there's zillions of cycles and indicators, but these are the 4 that matter. They all point down into early 2020, the next 3 years. So if we don't have a financial crisis in the next 3 years, I'm going to hang up my hat and move to Australia and become a limo driver.
Okay. Well, that gets us to the title of the book, The Sale of a Lifetime. And you speak about there being a bubble, more importantly, a bubble that's bursting, and even more importantly, the fact that we don't normally see them. So tell us a little bit about how we could see them, and more importantly, what we might be able to do to insulate ourselves from this particular bubble that you currently see and talk about in your book.
Well, there's a number of important things about bubbles. We only see a bubble economy once in a lifetime. The last bubble peaked in 1929. Real estate, stocks, all types of things. It only comes in what I call the fall bubble boom season over an 80-year cycle that I've tracked. 2 booms, 2 busts, inflation in one bust, deflation in another bust. So each one of my first things to entrepreneurs and business people, you have to have a different strategy for each season. Different things are important, and the economy's different. So that's one thing. Second thing, when you do get a bubble economy, like we've seen, especially since 1995, bubbles, we've had 3 bubbles in stocks now. That's rarely happened in history. We've had 2 bubbles in real estate. This is global. It's all around the world, including emerging countries. When bubbles occur, people don't see them, and the reason is they're getting something for nothing for a period. All of a sudden, your stocks are going up 20% or higher a year instead of the normal 7% average. Your real estate's going up 10 to 15% a year instead of the normal inflation rate, which is what real estate correlates with long-term, of 3%. And so you're getting something for nothing. And then now the government steps in and pushes interest rates down to 0. Now your car loans are cheaper. Your mortgages are way cheaper. People love this stuff. And so when somebody like me comes and warns, oh, this is a bubble, no, they tend to listen to all the other analysts and say, well, this time it's different. It's not a bubble because of this. I'll tell you what bubbles, what we show in this book, and I've got tons of charts in here, Jay, for one reason. I map out so many different bubbles, past and present. What bubbles look like exactly, not a kinda, exactly look like is the Masters and Johnson's orgasm chart developed scientifically in the late 50s, early 60s. They go up exponentially. They have a final kind of blow off like we're here in this Trump rally. No good reason. Stocks are going straight up, thinking Trump all of a sudden walks on water and is going to create 4% growth with the worst fundamental trends in history, worse even than the Great Depression. It ain't going to happen. But the markets are doing what they do. They're bubbling up because people feel good and they want to keep going. So people don't want the bubble to stop. And governments don't want a bubble to burst because the last time we had a bubble boom burst, we had the Great Depression. That's the winter season in my 80-year model. And so, of course, I mean, that's why governments are doing everything possible. They know. Ben Bernanke knew. He was a student of the Great Depression. He knows what happens when you get deflation and debt deleverage and these bubbles burst and all of a sudden stocks go down 80, 90% and don't come back to those levels for 20, 30 years. A lot of wealth is destroyed and the economy goes through the worst downturn you'll see in a lifetime. So governments are pumping in money. They're trying to keep the bubble going. You can't do that forever any more than anybody can keep an orgasm going forever. It just takes too much energy. And bubbles destroy themselves from their own extremes. So that's a main theme in this book. All of our past books have been about key cycles and demographics and, you know, why boom and bust and where around the world. This one focuses, in addition to that, You got to understand bubbles. You got to see what they look like. You got to accept these are bubbles. And you got to understand that as high as bubbles go and as fast as they grow, they crash twice as fast, and they eliminate the entire bubble in a short period of time. So if you don't get out near the top, and it's better to be a little early than late since they crash twice as fast, and since the first crash of a 2 to 3 year stock bubble crash tends to see half of the crash in the first 2 to 3 months, you better get out a little early rather than late. So we're warning people, this is a bubble, looks like a bubble, walks like a bubble, quacks like a bubble. Don't listen to any economist, analyst, or politician that says, oh, it's not a bubble because this. I don't care what causes a bubble. I care when trends in financial assets or stocks or real estate or anything starts growing much faster than the fundamental underlying trends and gets into a blow-off phase like this. And this is the final phase in this bubble. My best guess, and it's hard to pick, short term, but this thing goes into the summer and then blows up in the second half of this year. And then we've got 3 years of the worst stock market, worse than the 70s, worse, almost as bad as the 30s. And again, if you're safe and you got capital and cash, or if you're an entrepreneur and you've maybe, have some source of income or keep your job, but start building a business on the side, you're going to have a lot of opportunities. When things go down, the opportunities open up at the speed of light.
Indeed. In fact, that's in 07, 08, specifically 08, when things broke, that's how I made it in to the real estate market, is because things were breaking. Yeah. And
what better time to go into real estate when it's on its back and you can pick up properties, in foreclosure for cents on the dollar. Yeah. I mean, that's exactly, but you got to see it coming. You got to have here's what I'm going to do if this happens. And you got to have some source of capital to be able to do it, or some source of cash flow and income. But if you do, that's right. I mean, that's why I call this book The Sale of a Lifetime. Whether you're just an ordinary investor or you're an entrepreneur, this is when the opportunities are going to open up, but you're not going to be able to go to a bank and borrow money to do your vision. Not going to happen.
Yeah, that's one of the key skill sets that we often talk about, is how can you operate, especially as a real estate person, without traditional bank financing, and making sure that the investments that you do have spin off income on a monthly basis, so that when you're talking the bubble bursting, you're talking about the value of an asset. But if I don't ever have to sell the asset because it's out there in operation, that should seem to me to be something of a hedge or a way to ride the wave, so to speak.
Yeah, but the major thing is the businesses that hunker down in the top of a bubble. I don't care how bad the economy gets. In every sector or industry, local, national, global, whatever, some businesses are going to survive. And the second, as we said earlier, as a lot of businesses go under, a lot of these assets are going to be available in Chapter 11 or Chapter 7 reorganizations. And if you've just got a reasonable amount of cash or some investor to back you, you're going to be able to pick this stuff up at cents on the dollar. And the other thing is, if you're going to start a business in a sector you're interested in that becomes wide open, then worst of all, you just do it bootstrap. You do it one step at a time, and you do it with the capital you have, even if it's little, and you do it,
right.
One way or the other. You have to move. And there's going to be a narrow window of time when these opportunities come, and that's going to be particularly, I'd say, between later this year and early 2020. That's where the best part of this sale of a lifetime in businesses and financial assets is going to happen. So especially, I mean, if you can sell, if you got a business now or some real estate that you can sell, well, then you got a treasure chest of money to use as an entrepreneur and an investor during this sale of a lifetime in the next 3 and maybe as long as 6 years.
So, and you bring in, there's two things I want to ask you now. One, we brought up a number of different asset types, between businesses and real estate, stocks, and those types of things. Where do you think precious metals plays in something like this?
We got people out late April 2011 at the day of the top of the silver market and about 4 months ahead of the top of the gold market, because we said, look, gold and silver is a bubble. Gold went up 8 times between 2001 and 2011, longer and a bigger bubble than the stock market. And now, like all commodities, those bubbles are bursting along with oil and everything else and copper. And we predicted that. That's a 30-year cycle, by the way, that we said was going to peak between 2009 and 10, and it peaked in mid 2008 and second time in early 2011. And, those bubbles are going to burst. Now, and gold is an inflation hedge. This is a deflationary crisis. When bubbles burst and debt is restructured, a lot of money and wealth is destroyed. So there's less money chasing the same goods and same financial assets, so they go down in value. Again, a hint. Why the sale of a lifetime? Why the millennials are going to be able to buy houses and a lot of things and healthcare and education and things cheaper than now in the future, because those inflation bubbles are going to be broken by deflation. So the opportunities are going to come from deflation, and we go over that in the book as well. We have a spring boom, a summer inflationary bust, a fall bubble boom with falling interest rates and inflation, and then we have a winter season where everything gets deleveraged, and that is the most opportune season if you don't go into it blind and see all your wealth and income and cash flow disappear.
Well, in the situation that you're describing, what comes to my head is, having practiced many different forms of building cash flow, it would seem to me that either, buying existing streams of cash flow, specifically debt on buildings is what I'm thinking of, notes and debts on buildings, could be an interesting opportunity if purchased properly today. Like, that's something I would do today in preparation for that collapse, and knowing that the owner is likely to end up in a situation because of all of these things.
Right, and then you take it over. That's what the mafia did. Mafia gave shark loan rates to people who couldn't get credit, and then when their business went over, they took over their business for pennies on the dollar. And the truth is, most people paid the mafia instead of the banks, because they break your legs if you didn't. So there's so many ways to make money on this, and there's going to be a lot of loans that fail, and you can walk in and buy those loans for 20 cents on the dollar after the worst has happened, maybe 3 years from now, and you got a much higher chance in the future of getting paid off. So there's a ton of ways to do this: buying debt, or buying companies at 20 cents on the dollar, or making investments in a market segment that a lot of companies just exited and there's nobody to service it and it's wide open. And or you're starting a new business, in a sector that's going to be benefited by the continued predictable aging of the baby boomers, like funeral homes and nursing homes, or young millennials. Young millennials have not been buying as many starter homes. They've been renting more. At some point, when things get better several years from now, they're going to want an affordable starter home. The people who can buy those in the downturn, rent them out for cash flow while things are bad, and then turn around and sell them to aging millennials will make money in both of those strategies.
Okay, now we got to go to the new thing that I've been doing, because it's funny. So because of what you just said right there, recognizing that trend, one of the things that we've been doing inside the Cashflow Diary community, myself personally, it has been gaining control of real estate for the specific purpose of renting it out in a short-term fashion to specifically millennials and that generation who don't want to, right now anyway, own a home, but they don't have a problem renting a home. And I have a number of millennials who literally are, they don't have a permanent residence. They literally rent from me on a short-term basis so that they don't have they're not tied down, and they continually do that. And if I heard you correctly, you're saying that trend could last maybe another 3 years before they decide okay, I'm finally ready to own something.
Yeah, I'd say 3 to 6 years. You got to remember, real estate, although it took the worst of its hit in 2008, like the stock market, it peaked earlier in early 2006 and didn't bottom until mid to late 2012. So real estate takes longer to come down. So I think that these opportunities in buying cheap real estate or taking over debt at cents on the dollar is probably going to last into about 2022. So 5 or 6 years.
love everything you're saying, by the way. Now, there's something that you said a little bit ago, and I know if I don't ask it, we're going to get a bunch of emails. So I got to know what you said there were 4 indicators that told you or pretty much gave you the understanding of what was about to happen. What are those indicators? Is this something that's publicly available knowledge? How come no one else knows what these indicators
none
are?
of this is publicly available knowledge,
okay.
but it's definitely in the book. Okay, I'm going to go in order of where these 4 peaked.
Okay.
I have a geopolitical cycle that is positive for about 17 to 18 years and then negative for 17 to 18 years. 83 to 2000, almost nothing went wrong in the world. 2001, 9/11 forward, everything's gone wrong. That should be pretty obvious. That cycle peaked in 2000 and doesn't bottom until 2020. So that cycle's still going to be bad for the next 3 years or so. Okay. The second cycle to peak was the demographic cycle. I call it the generational spending wave. That peaked in 1996 for Japan, 2007 for the United States, 2011 for Europe, and the last couple countries to peak on that are Spain and South Korea in 2018 and stuff. But these generation cycles have been peaking around the world and turning down. The third one is an innovation cycle that impacts productivity. For companies and workers. That peaks every 45 years like a clock. Steamships peaked 1875 and then dropped like a rock when railroads came along, then railroads in 1920, automobiles saturated and superhighways 1965, and of course recently around 2010, the internet and all of this sort of stuff. There's always innovation, but it's when key clusters of technologies like automobiles and phones and radios and things like that, when they come together and move fully into mainstream, affecting mass markets and everyday people, that's when the economy is best. And we've seen the best of the internet now. Now we're down to Facebook, which is very entertaining, and it's going to grow, but it's dancing dogs and cats. It's not email, Google, and stuff. I mean, those 2 things right there probably tripled the productivity of my research business. And then the final one, and this is my secret, the 10-year boom-bust cycle identified by Ned Davis many decades ago, and I've been following it all my life in the early 60s, early 70s, early 80s, early 90s, early 2000s. We've always had the biggest stock crashes and recessions in the first few years of every decade. Well, it didn't work in 2010 to 12, so I had to dig, and I found a scientific indicator, something I would not be able to project, but scientists can. It's called sunspot cycles, and that's the real cause of this cycle. And this is the cycle that's not clockwork. It averages 10 years, but it can be 8 to 13. So I've got a way, scientists project these cycles very accurately, within months of peaks and bottoms to get close. And that cycle was the last to peak in 2014, and it points down by scientists' estimates into around early 2020. So all 4 of these cycles point down together from about mid-2014 to early 2020. And since this happened, all 4, the stock market went straight sideways from late 2014 into late 2016 until we have this crazy Trump rally, which is total BS. It's not going to last several months. And they continue to point down and get worse. So again, these 4 indicators, this only happened in the early to mid 70s, that they all pointed down at the same time, and the early 1930s, the 2 worst financial crashes and crises in the last century. So this says very, very high chance we get a major financial crisis. Yeah, they've stretched the economy with quantitative easing. Yes, they've had 0 interest rates. Now Trump's going to cut taxes. Okay, you can only stretch a worn-out economy so far. Old people don't get more productive, they get less. They don't spend more money, they spend less. They pay down their debt. And they retire and do nothing, and then they die. And with the baby boom so large, there's no way these trends can be good. And Japan's already told us what happens. Japan's real estate went down 65% and has never bounced 26 years later. And their stock market went down 80%, bounced, and is still down 60% from its all-time high, and the Nikkei will never see 39,000. So Again, these 4 cycles are important. The demographics came to me a long time ago, mid to late 80s, but these other cycles I've added over time. When something happens I can't explain, I go, well, there must be another important cycle, and I will dig if it takes a year or 2 years, and I will eventually find that cycle. And I found the geopolitical cycle when the second stock bubble, which I totally predicted, a book called The Roaring 2000s, wasn't as strong as the first bubble, and the economy was as strong, and earnings, everything I was looking at were as strong. Stocks only went up half as much as I thought. That was because the geopolitical cycle. Stocks do half as well in that down cycle, and so I had to dig for many, many months to find that, but I found it. And because I'm a fickle guy, so if anybody will sniff it out, I will. So these 4 cycles. It takes the demographics is still the most important, but for timing crashes, this decennial boom bust cycle is the most important. And this one's saying, hey, expect a crash anytime in the next 3 years, and likely sooner than later.
Got it. Now, for those that have listened this far and, that they are, picking up what you're putting down and enjoying the fact that you take the time to dig and sniff and understand, and maybe they want to, track you down and find out more about what you've got going on, or even pick up a copy of your latest book, what's going to be the best way for them to find out more about what you guys got going on?
Yeah, I mean, number one, this book just came out in early January. We self-published it before that for our own newsletter subscribers and stuff. It came out in early January. Amazon's the quickest and cheapest way to get it. Get that book. And, you got several months here before fireworks go off, and you need to be convinced if you're going to make some hard decisions about your business pursuits or your investments. Second, we have a free daily newsletter. We also have paid newsletters, but we have a free daily newsletter. You can get that by just putting your email in the top right corner at harrydent.com. That's simple. All you do is put in your email. You can get to know us better and other people that work for me. And then you can trade up to our paid newsletters if you want to, but at least get on that free newsletter. You can't go wrong with that. So those are the two best things you can do right now to learn more about what I do.
Excellent. And as we wind down here, I've got a final question for you because I'm really curious to hear your answer. Let's pretend for a moment that, someone listening, they're standing in front of what I would call the superhero outfit store. They think they want to move forward and make entrepreneurship happen for them. However, in the back of their mind, when it happens a lot to all of us when we go, hey, I want to be great. But we have our voice. That voice comes in and says, no, who are you to think you can? And why this? And you can't make that happen. And all of those things. And now we're going to add to that voice everything that you've just said, here today. That person could feel like they're stuck. But let's pretend that they are actually going to do something. Let's pretend that they're going to do in the next 24 to 48 hours exactly what you suggest. What would you have them do?
Well, again, you have to sell any financial asset that's not strategic to your business or to your life and create as much cash as possible. You got to cut your living expenses and your business expenses as much as possible. The people who have stronger cash and cash flow coming into this crisis are going to be the ones that can take full advantage of it. It's that simple. Hunker down now and be prepared to pounce on opportunity after opportunity in the next 3 to 6 years.
Love it. I definitely appreciate you taking the time to share your knowledge, insight, and wisdom here with us at the Cashflow Diary today.